What does lender of last resort mean for central banks? Have you ever wondered how central banks step in during financial crises? One of their key roles is acting as a lender of last resort. This means they provide emergency funds to banks that are struggling to find money elsewhere. When financial institutions face short-term funding issues, they can turn to the central bank for help. This function is vital for keeping the financial system stable and preventing panic among the public. The lender of last resort role is especially important during times of economic stress. If a bank is solvent but temporarily unable to meet its obligations, the central bank can step in to provide liquidity. This helps prevent unnecessary bank failures that could arise from a lack of cash flow rather than actual insolvency. By supplying funds, central banks help maintain the overall money supply and keep financial markets functioning smoothly. The concept of a lender of last resort dates back to the 19th century. Economists Henry Thornton and Walter Bagehot laid out some guiding principles. They suggested that central banks should focus on protecting the overall money supply instead of individual banks. They also advised that only sound institutions facing liquidity problems should receive assistance. Additionally, they recommended that central banks requiring good collateral and charge higher interest rates to discourage risky behavior. In practice, when a bank cannot find funds through normal channels, it can approach the central bank for emergency assistance. This lending is typically a temporary solution aimed at restoring confidence in the banking system. Major central banks, such as the Federal Reserve in the United States and the European Central Bank in the Euro area, share this responsibility and play a crucial role in maintaining financial stability. However, there are some concerns about this practice. Critics argue that providing support can lead to moral hazard. This means that banks might take excessive risks if they believe they will be rescued by the central bank during tough times. Balancing the need to prevent financial collapse with the discipline of allowing failing institutions to close is a delicate task for central banks. In essence, the lender of last resort function allows central banks to act as the ultimate source of liquidity during crises. This role is vital for supporting financial stability and ensuring the economy continues to function smoothly. By understanding this concept, we can appreciate how central banks work to maintain trust in the banking system and the economy as a whole.